Warren Buffett is known as one of the world's greatest stock pickers. But did you know that in $1 million bet he made to any and all investment professionals, he chose a single fund and went on to win the bet? In this video, I'm going to show you exactly which fund he chose, how he won the bet, and why. And for many investors out there, this one fund is all you need to do when it comes to your money in the stock market. Now, there's a lot all of us can learn from Warren Buffett. In fact, there's a lot we could learn about Warren Buffett when it comes to frugality. Did you know that according to Business Insider, despite the fact that he is the 6th richest person in the world with a net worth of roughly $107 billion as of 2021, he eats McDonald's for breakfast most days? He drives relatively inexpensive cars, he drinks Coca-Cola, and get this, he lives in the same house he purchased in 1958. And in 1958, he bought it for $31,500. Let me reiterate that. The man who is worth $107 billion lives in a house that he bought in 1958 for $31,500. He is the master of frugality, but he is also the master of the stock market. And that's why in 2007, he made his famous bet. Buffett essentially bet that he could take on any investment professional, specifically hedge fund manager, and over a period of 10 years, he could invest in a single mutual fund, an index fund, and allow that investor to choose 5 or more hedge funds to invest in. They would compare returns, and then the winner would ultimately be able to donate $1 million of the winnings to charity. These were the terms of the bets. Now, some of the reasons behind this have to do with Buffett's views toward hedge funds and the high fees they charge for their investors. Your typical hedge fund is going to charge 2% a year on all assets in the fund. And not only that, but the typical fund will then charge 20% of the profits. Now, you might think, well, if you're making a lot of profits, why does this matter? It matters because in the end, that significantly cuts down on the profits a person could earn in the stock market. Take a look at the following chart. Let's say that in this particular hedge fund, you invest $100,000. Let's say that you make a 10% return on your investment for the year. That brings your total to $110,000 or $10,000 in earnings. Now, that's great. That makes you feel good. But then let's take away some of the fees. First, take away the 2% charge on your total assets, and your number that you earn shrinks to $7,800 after the $2,200 taken off the top. Then, take away the 20% charge on profits, and your number shrinks again, this time to $5,800. So, instead of getting a 10% return, you just got a 5.8% return on your money. Now, that's just some food for thought. Now, Warren Buffett's bet relied on his own tried and true feelings and beliefs about the stock market. In fact, in his own words, making money on the stock market does not require great intelligence, a degree in economics, or a familiarity with Wall Street jargon. What investors then need instead is an ability to both disregard mob fears or enthusiasms and to focus on a few simple fundamentals. Stick with big, easy decisions and eschew activity. In other words, in his own words, pick a good index fund, preferably one that mirrors the S&P 500, and stick with it. Hold on to it for the long term, and you will beat most of these so-called investment professionals. That was the premise of Warren Buffett's bet back in 2007. Okay, so how exactly was this bet going to work? First, the winner was going to get to allocate $1 million toward the charity of his or her choice. So essentially, Buffett and his competitor would each take $320,000 and put that into a treasury or bond that over the course of 10 years, which was the length of time of the bet, over 10 years, that $640,000 would grow to $1 million, which could then be donated to charity. Then the next step of the bet would be that Buffett and his competitor would each select a fund. For Buffett, it was a single index fund. For his competitor, he was allowed to choose 5 hedge funds that he would invest in. The period of time was 10 years. So over the course of those 10 years, It was to be determined which of those funds brought greater returns for the investor. And then the winner got to take the earnings and give it to a charity of choice. So Buffett announced this bet in 2007. He essentially throws down the challenge. And his index fund of choice? None other than the S&P 500. Now, when it comes to the S&P 500, it's worth knowing that he invested solely in what's called the Vanguard 500 Indexed Fund Admirable Share. So what this essentially is an index fund that tracks the S&P 500. And the S&P 500 is an index fund composed of the 500 largest publicly traded companies in the United States. In other words, when an investor invests in the S&P 500 or this index fund, or for many of us it's investing in SPY, which tracks the S&P 500, or other index funds that track it, you are essentially buying a small piece of each of these 500 companies. Now, why is that a good thing for the investor? It's a good thing because your success in that index fund does not rely on the success of any one individual company. If you pin all your hopes on Tesla or Apple or any other single company, your hopes will rise and fall with the success of that company. But in an index fund such as the S&P 500, your hopes and successes will rise and fall based on the success of those 500 companies. In other words, you are essentially diversifying your portfolio even though you're buying a single index fund. This was the premise of Buffett's bet back in 2007. He threw the challenge down and then he waited for his competitor to step up to the scene. And he waited. And he waited. And then crickets. And more crickets. And then nothing. And then finally, someone steps into the limelight to take the challenge. This is none other than Ted Seides. Ted Seides at the time was asset manager of Protégé Partners. Ted takes the bet, Ted selects his 5 funds of hedge funds, and the bet begins. The years? 2008 to 2017. Now, before we get to the end of the bet, and spoiler alert, Buffett wins, and he wins by a lot. But before we get there, let's look at a very interesting turn of events. If you remember, the $640,000 that was put into bonds, hoping to become $1 million by the end of the decade, and that million would be donated to charity, by 2012, both Seides and Buffett decide that the lackluster returns on that investment are simply not worth it. So they take that money from the bonds and they put it into Buffett's company, Berkshire Hathaway, and they buy Class B shares of Berkshire Hathaway in 2012. Now, that's $640,000 that was expected to become $1 million by the end of the bet in 2017. Because of that investment in Berkshire Hathaway, by the end of the bet's terms in 2017, that $640,000 itself had actually become a whopping $2.2 million. So really, in the end, the big winner of Buffett's bet, not necessarily Buffett, certainly not Seides, but the charity, in this case, Girls Incorporated. And perhaps the tagline of this company makes sense when it says that this is a nonprofit inspiring all girls to be strong, smart, and bold. In fact, those 3 characteristics could represent any investor taking Buffett's advice in this particular indexed fund. Now let's take a look at the bet itself. The date range that we had was from 2008 to 2017. Now, to those of you familiar with the stock market and those of you who've been around a few years, you'll remember that 2008 was no friend to the stock market. In fact, in 2008, because of the housing bubble and because of all the crazy things that happened with regard to the crash, the S&P 500 dropped by, get this, 38%. Yes, that's right, 38%. So right out of the gate, the bet that Buffett made in the S&P 500 was down a whopping 38%, and things did not look good. Well, they looked good for Ted Seides, not so much for Warren Buffett. But you have to remember, this bet was for 10 years, not for a single year. And starting the very next year, and for just about every single year after, Buffett's fund of choice grew incrementally and had better returns on average than the hedge funds. This brings us all the way to May of 2017, when a very interesting op-ed appears in Bloomberg written by none other than Ted Seides. The title of the piece? Why I Lost My Bet with Warren Buffett. Ted Seides concedes his victory and essentially shows how Warren Buffett beat him and basically called the bet over even before its official end in December of 2017. By the end of the bet, and when the dust had settled, Buffett's wager, Buffett's index fund of choice, had averaged a return of 7.1%. Now compare that to the return of the hedge funds of choice, which brought back a 2.2%. Now let's look at those in some real numbers. This basically means that Buffett's choice saw a cumulative return of $854,000 because of the beauty of compound interest, while the hedge fund choices brought back a measly $220,000. That is a 3-to-1 beatdown. That's a boom. That is a mic drop moment for Warren Buffett to say, look, this simple, this easy, this straightforward pick beat the highly paid investment professionals. Essentially, this is the stock pick for the every individual, for the investor who is looking to make a single transaction in the stock market, to hold it, to weather the storms, to play it relatively safe, and to look for the longer term. The rewards and the yields in an index fund such as the S&P 500 are simply hard to beat. It works, and Buffett proved it with a 10-year bet. Okay, so it works, but why does it work? The reason that it works is because, as we mentioned earlier, when you buy into an index fund, you are not buying into an individual company. You are not putting all of your eggs in one basket, so to speak. It might feel that way because an index fund trades just like a single stock does, but you are buying a share of all of the companies reflected in that particular index fund. In the S&P 500, you are buying a piece of all 500 of those largest publicly traded companies in the United States. This is going to greatly increase your chances of success. So for many of us out there, it might be as simple as buying an index fund that tracks the S&P 500, sitting back and waiting, and watching our money, although it may drop some years, over the long term, cumulatively add up with impressive returns, just like the ones that Buffett saw over the course of his 10 years. It really does work, and that's the beauty of it. However, for those of us who are looking for something a little different, those of us who might be looking for something a little bit more, there are other options out there. Now, before we get into any of those specific options, it's worth mentioning that the S&P 500 essentially is the market. So when we talk about returns and we use phrases like beating the market or lagging the market or tripling the market or falling behind the market, you need to understand that if you're invested in an index fund that tracks the S&P 500, you essentially are the market. Why is this nice? Well, because it means you never will lag behind the market because you are the market. Now, it also means you won't soar past the market because, again, you are the market. You are that definitive market that shows the success of the S&P 500. So what happens if we are looking for something different? Something that perhaps has consistently, over proven backtesting, beaten the market year after year. That's when we come to something like the 12% solution. So you might be wondering, what is the 12% solution? Well, it is a strategy based on the book by the same name by David Alan Carter that's specifically written for those investors who are looking to outperform the market over time. Those who want to do a little bit better than the S&P 500, who want to stride past what the market is returning on a regular basis. And it relies on a few key principles, such as the trading of specific ETFs on a monthly basis. It requires about 20 minutes a month, and a computer, and an investment account, and then the individuals will be well on their way to earning 12% returns on average when using a few simple but tested techniques to outperform the market. So hey, if you want to read more about that and get the specific details, it truly is a do-it-yourself technique when it comes to the stock market, then check out the book. There is a link below to check it out, and additionally, make sure that you subscribe to this channel, as you'll get more inside information on the strategy as well as other aspects of the stock market that will probably influence your investing and the returns that you'll get. Hey, thanks for watching.